Looks fun, huh? Think again. That's not an amusement park ride. That's a group of bank stock investors strapped into today's stomach-churning market. Good afternoon. It's Tuesday, June 5th. I'm David Riley. You're on Mean Street. Well, stock market overall has been pretty volatile, but one of the roughest going has been in bank stocks over the past few days. They've been up, they've been down again. Here to talk with me about it, WSJ's banks editor, banking guru, Colin Barr.
That's me.
Colin, are you a big roller coasters fan?
I am. I love Kennywood, of course, is in Pittsburgh, as we all know, and so that's I grew up there, and that's the roller coaster capital of the world. We say, mostly falsely, but we say that.
So the bank stocks right now, that'd be nothing to you.
No, nothing at all. Nothing at all.
No.
The up and down, as you say, though, it's been amazing because we had a big run up during the first quarter after last year's roller coaster ride, and then we've had a big move down, and then today they're up, and everybody says, what's going on here? And there's so many different factors at work. So
one thing though, also today we're up about 3-4% of some of the bank stocks. Last Friday we were down 4-5-6%. So why is this? Why are they jerking around so much more than the broader market?
Well, we're back to the thing where we were at the end of last year, where it seems on certain days like the world is about to end. We remember this from 2008.
Is it ended?
It doesn't seem to have. seems to be going okay right now. But so, in Europe, there's a lot of concerns about what's going to happen in Spain and Greece and these sorts of questions. Are policymakers up to the task? We all have our questions about that. And so the bank stocks, if you have a big event in Europe, it's going to be bad for the banks. Everyone sort of agrees on that. And so that seems like the number one factor.
And sort of on screen right now, we have a couple of these unsettling forces: the banking rules, the weak economies, the fearful investors hitting profits, and global shock threats from the euro. That last one, the euro, that has to be a big factor in what's happening now.
It is, even for the U.S. and banking regulators here have made clear that they're not concerned about direct effects. They're not concerned about something happening in the euro and then Citigroup, for instance, or J.P. Morgan or Bank of America. They're not worried about direct exposures, billions of dollars in losses from a direct thing. What they're worried about is the global economy going in the tank again, and that hurts everybody's profits.
But do you think it's just that? I mean, because investors seem to be really worried that if you're a Morgan Stanley, a Citigroup, or even a J.P. Morgan, that you could have some blowback more immediately.
Well, I mean, I think there's the question, we all remember 2008, and there's this question of what happens to funding markets if you have something bad happen.
And speaking of that, right now on screen, we've got Morgan Stanley and Citigroup. See, they're up 3.6%, but that's a pretty long sloping.
Yeah, well, I mean, and look at Morgan Stanley has been really remarkable. I mean, they were up 40% earlier this year. They, the stock was hit hard last year with these sorts of questions. It went up this year. People were starting to say, maybe we're finally going to have a year-long economic expansion. Maybe, the LTRO, which is what the ECB did to settle the funding markets in Europe, maybe that'll work. Maybe that gives us an entire year in which we don't have to fight fires. And then
that didn't work out so well
sentiment
so far.
is not really held. So, and Morgan Stanley has gone down to almost where they were at the end of last year, which is sort of a panic sort of low. But it's amazing how quickly we got there.
That's also because with Morgan Stanley, because you have worries about their credit rating being cut too.
Right, and people expect they're going to have a Moody's downgrade in the next couple of weeks here. Moody's has said they could downgrade them as much as 3 notches, which it's another one of these kind of 2008 replays. We know that that's bad. We know the company says that they can make that it's finite. The damage from that is finite. It'll raise our costs this much, we'll have to produce this much more collateral. But everybody wonders, what do we not know about that sort of scenario?
What do you think? Do you believe James Gorman when he says that?
It's hard to take anybody at their word after 2008 because there are so many people who are saying the financial system is strong, and we all can see that the banks have raised capital and that they're more liquid, and it's very easy to make the case that a lot of these fears are overdone. But it's impossible to say for sure.
But very quickly then, right here now where bank stocks are they a buy or no?
I guess I don't think I would be probably out there buying with both hands right at the moment. I mean, you and I have discussed this 1,000 times. The way the bank stocks are trading right now, it's much lower than their stated values, right? If you look at what their reports say, if you look at their 10Ks, it's very easy to make the argument these guys are very, very undervalued. They trade at 30-40% of book. And so
but you're not ready to jump in yet.
It's so hard to see how we get a good result in Europe right now. And I don't want to be the guy who says that they can't do it. I'm sure they can do it, but the Lehman Brothers, the events of 2008 showed us that a lot of times you need to have something really, really bad happen before the policymakers, galvanize
Get
around
their hands around
right
it.
Around something that's not going to. Germany doesn't want to pay for everybody else in Europe.
All right. Well, here's the one thing I'll guarantee you that is ahead for bank stocks. Thank you, Colin. You can go back, find a roller coaster and enjoy the afternoon.